Hello, this is Leroy Meadows, and I want to thank you for joining me this session. In this session, we're going to talk about decision making and relevant information. Now, this chapter is broken up into two different videos, so make sure you see part two. So let's go ahead and get started here, and let's take a look at what we're going to cover in in these two videos here. First of all, we're going to talk about the five-step decision making process. We're going to distinguish relevant from irrelevant information in decision situations. We're going to talk about the concept of opportunity cost, and why we should consider it when making insourcing versus outsourcing decisions. We need to know how to choose which products to produce when there are capacity constraints. We'll talk about how to manage bottlenecks. We'll talk about factors that managers must consider when adding or dropping customers or business units. Explain why book value of equipment is irrelevant to managers in making equipment replacement decisions. And then finally, how conflicts can arise between the decision model that the company uses and performance evaluation model that top management uses to evaluate managers. Okay, so when we talk about decision making process, we're talking about a formal decision model for choosing among alternative different courses of action. So a decision model is a formal method of making a choice that will involve both quantitative and qualitative analyses. Management accountants will analyze and present relevant data to guide managers' decisions, and we're going to use the five-step decision-making process presented in Chapter 1 to make decisions. So let's go ahead and take a look at the decision-making process for precision sporting goods. Now, let's take a look here. And let's go to the ebook so we can see this a little bit better. Okay, so step one in the decision-making process is identify the problems and uncertainties. Now, precision sporting goods wants to reorganize its manufacturing operations so it can reduce manufacturing labor costs. So that's the question. Should we do that? Should we not do that? One uncertainty is how will it affect employee morale? So then we go to step two, obtain information. Historically, wage rates have been $14 an hour, but because of a negotiated increase recently in employee benefits of $2 per hour, our labor costs will go up to $16 per hour. So the reorganization plan will reduce the number of workers from 20 to 15. And how do they do that? It's by eliminating all 5 workers who handle materials. And the company, when it obtains information, decided that it was likely to have a negative effect on employee morale. So we get all the information, then we make predictions about the future, step 3. We're going to use the information from step 2. All the information we gained, we're going to predict future manufacturing labor costs. Under the existing do not reorganize alternative, costs are predicted to be $640,000 per year, and under the reorganization plan, they should be $480,000 per year. So in other words, there's going to be a big difference here. And then also the cost to reorganize is going to be $90,000. So let's take a look here and figure out what is that difference going to be. Well, first of all, there's a difference in the labor costs as they currently are if we do not reorganize, and between that and the cost of labor if we do reorganize of $480,000. So the difference is $160,000. Now the reorganization plan is going to cost us $90,000. So that $160,000 in savings is going to be reduced by the cost of reorganizing. So altogether, our plan will save us, on paper anyway, $70,000. So, step 4, managers will compare the predicted benefits and calculate in step 3. And then they get that savings of $70,000. They get the $160,000 difference in labor costs between both alternatives. And they also account for that $90,000 of additional costs to reorganize. And that's on a per year basis. along with considering qualitative information like negative effects on employee morale, and management decides to reorganize because the financial benefits are significant and they believe that any type of dip in employee morale is going to be temporary and relatively small. Now in step 5, the company evaluates performance after the decision is implemented. And step 5 is we got to implement the decision first, then we'll evaluate, and then we'll perform and learn. Evaluation should be once a decision has been implemented and all the way through till the end of the project or until we get a lot more data, end of the year, whatever it is. Should not be just occurring at the end of when we get all the results in. We should be evaluating the performance as we go along. In this case, the managers learned from the actual results that the new manufacturing labor costs are going to be $540,000 rather than the predicted $480,000 because of lower than expected manufacturing labor productivity. And they also learn about the effects of employee morale. Now, this information that we're learning now, because we're evaluating the performance, that's past or sunk information. That's past information. It has no bearing on future decision making opportunities. So the company is now going to have to evaluate and then learn. So what is a company learning? Making better predictions, improving implementation via employee training, increased employee engagement, and better supervision. So that $70,000 we had, let's see here. And let's calculate the actual savings based on the reorganization plan. So we had $640,000, and we were expecting the labor costs to be $480,000, but actually they were $540,000. So what was our actual difference? Our actual difference in labor costs was $100,000. Still not too bad, but don't forget we had the cost of reorganizing, which was $90,000. So our true actual savings, $10,000. And what happened to save $10,000? We lost a lot of productivity, employee morale went down, and so forth. So based on the numbers, we still came out ahead, but we've also got to apply qualitative information to our decision-making process. And it sounds like the company tried to do that in this situation, but maybe they didn't take it seriously enough. And that would be just a subjective opinion based on the numbers and what the company had gone through. So let's take a look here and go back to our PowerPoint. Now, when we talk about relevant information, it's going to have two characteristics. One, it occurs in the future, and two, it differs among alternative courses of action. These are the two characteristics that have to be in every bit of relevant information. If it occurs in the future, if we have a piece of information that occurs in the future but does not differ between alternative courses of action, then it's irrelevant. Why? Because no matter which decision we make, we're going to have the same result. On the other hand, if the information does differ between alternative courses of action, but it already occurred as far as in the past, then that decision is not relevant because that cost already has been incurred. In fact, we would call that a sunk cost or historical cost, because no matter what we do now, we cannot change what happened before. So when we talk about relevant costs, we're talking about expected future costs. When we talk about relevant revenues, we're talking about relevant expected future revenue. So we're talking about anything with regards to relevant costs, they're going to be expected future costs. With relevant revenues, they're going to be expected future revenues. Now, when we take a look at the information in the decision-making process, we're going to have two different types of information, quantitative and qualitative. Quantitative is outcomes that are measured in numerical terms. It can be increase or decrease in operating income by, let's say, $10,000. Or it can be manufacturing cycle time, 4 days. It could be delivery time, 3 days. Quantitative factors are outcomes that we measure in numerical terms. It can be dollars and cents in financial terms. It can also not be in financial terms, but we can still put a numerical value to it. Qualitative factors, on the other hand, are outcomes that are difficult to measure in numerical terms, such as employee satisfaction, customer satisfaction, employee morale, so forth. Now, even though quantitative non-financial factors and qualitative factors are difficult to measure in financial terms, so just because we can't put a dollar sign on it, we have to consider that as managers. Why? Because employee morale, that may be, that can lead to lower productivity. What about manufacturing cycle times? Well, if we make a decision and the cycle times increase from the time we get the order to the time it's ready to go to the client or to the customer, then will some of our customers be as apt to buy from us because it's going to take a lot longer for them to get their order. So we need to take both non-financial quantitative information and then qualitative information in our decision-making process, and we need to consider those. Now let's take a look at precision sporting goods. And let's go here. And let's go back to the book here for just a moment. Now, precision sporting goods here, and I want to do this one because this is a little bit better image here. Precision sporting goods has a thing to where, and this is the difference we were talking about here. This is the illustration. We have two ways we can present the information. We can present it as all revenues and all costs, and then sometimes we want to do just relevant revenues and costs. Relevant revenues and costs is good because we're only taking the relevant bits of information, things that we know we're going to change. Some people will do the all revenues and costs, and why is that? Whether they're irrelevant or relevant, because sometimes managers want to make sure they account for all costs. And the more complicated the decision is, maybe sometimes we need to list all costs to make sure that we don't miss something. But either way, whether we list all revenues and costs or just irrelevant revenues and costs, we come up with the same difference because the numbers are going to be the same no matter which method we choose. And that was going back to the decision whether to implement the reorganization or not. Now, when we look at, in fact, let me go back to the PowerPoint here for just a moment here. Now, let's talk about irrelevant costs in the decision-making process, and specifically sunk costs. These are costs that have already occurred that cannot be changed. And they're excluded because they're not going to be changed by future action. So no matter what we do in the future, it will not change in what we did in the past. For example, if I want to trade in my Trailblazer for a newer model of car, whatever it is, the money I spent buying the Trailblazer, the money I've spent in the past to repair my Trailblazer, that's irrelevant. Why? Because no matter what I do, I'm not going to recoup those costs. So if I have a decision now between A, repair the Trailblazer, or B, replace it, the historical costs or any financial costs associated in the past with the Trailblazer is going to be irrelevant. However, if I choose to put more money into it, if I'm thinking, well, I'm going to put more money into it, or let's say if I replace it, I'm going to sell it. Well, then the salvage value, the amount I get for the Trailblazer, the trade-in value, well, then that becomes relevant. Why? Because if I keep my Trailblazer, I won't get that trade-in value. I only get that if I choose in the future to trade in my Trailblazer for something a little bit newer, something a little bit better, something a little bit more solid. So things like that are, if it's going to differ between alternatives and occur in the future, then they are relevant. Sunk costs, because they do not occur in the future, is not relevant. Why? Because they cannot be changed. They cannot be changed by future actions. So let's take a look at some terminology real quick. When we talk about incremental costs, these are additional total costs incurred for an activity. The differential costs are the difference in total cost between two alternatives, alternative A and alternative B. When we talk about incremental revenue, we're talking about additional total revenue from an activity. And differential revenue is the difference in total revenue between two alternatives. So now let's go ahead and take a look at some types of decisions that we will need to make. One-time special orders, short-run pricing decisions, whether we should insource versus outsourcing, product mix decisions, bottlenecks, theory, constraints, and throughput margin analysis, customer profitability and relevant costs, should we aim a branch or segment, adding or discontinuing, and then finally equipment replacement costs. We are going to cover one-time special orders in this session, short-run pricing decisions, the insourcing versus outsourcing situation, and then finally product mix with decisions with capacity constraints. Bottlenecks, theory, constraints, and throughput margin we'll actually look at in the next video. And when we talk about the theory constraints, we're talking about methods to maximize operating income when faced with some kind of bottleneck and some bottleneck operations. So in order to implement the theory of constraints, we need to define and use three measures. Throughput margin. Throughput margin, if we remember from variable costing and inventory analysis, that throughput margin is simply the revenues minus direct materials. Investment equals the sum of the direct materials, and that's direct materials located in raw materials inventory or the materials control account, materials in work in process, materials in ending finished goods inventory, research and development costs, and capital costs of equipment and buildings, and then finally operating costs equals cost of operations other than direct materials. And we'll look a little bit more at that in the next video. So now, next video we'll talk about customer profitability, branch segment, adding or discontinuing branches or stores, and equipment replacement. So, first decision we want to look at is one-time only special orders. And the decision here is whether we should accept or reject special orders when there is no idle or when there is idle production capacity and the special orders have no long-run implications. So the decision rule is, does a special order generate additional operating income? If it does, we should accept it. If it does not, we should reject it. And in the one-time only special orders, we're going to compare relevant revenues and relevant costs to determine profitability. And one more thing I want to talk about here is that the special order should have no long-run implications. For example, what if the customer who approaches us to make a one-time special order now all of a sudden wants to become a normal customer, wants to start buying from us as one of their vendors? Another long-run implication is, what if we accept an order at lower than normal sales price, and what if our regular customers find out and they demand, like, say, a 15-20% discount on their product, on the products we sell to them? That's not good for business. So if we're going to accept a special order, it needs to be a one-time special order and have no long-run implications. So let's take a look at surf gear, and let's go back to the textbook here so that we can get a better understanding of this. So surf gear manufactures beach towels, and the capacity, and we see here the planned capacity of 45,000 towels each month. Current monthly production is 30,000. Who buys from them? Retail department stores account for all existing sales. Now, this is the expected results for August, the coming month up here. And these predictions are based on past costs. Now, we assume that in the short run, all costs can be classified as either fixed or variable, so we can get that one single cost driver, and that single cost driver is going to be units of output in this situation. So let's take a look here. Units sold, 30,000. So when we get a per unit basis, we're selling our towels, our beach towels, for $20. Variable manufacturing costs of $750, fixed manufacturing costs of $450, and that's because our fixed costs in total are $135,000. So per unit cost of goods sold, $12. Marketing costs, variable marketing costs are $5, fixed marketing costs are $2, so a total marketing cost $7. So what's the full cost of the product to make? When the one we're going to make our pricing decision on, our product mix decisions on, the full cost of the product, $19 per towel. So Surf Gear is actually going to profit $1 off that sale of the towel that sells for $20. Now, let's take a look here and go through this real quick and see which costs are relevant to a situation here. And we're going to do that when we learn that Surf Gear has a hotel chain, Azalea, that wants to purchase towels from Surf Gear. Now, Azalea already purchases from Munger Corporation, but the workers at Munger are on strike, so Azalea must find a new supplier, and this is just a temporary one. Now, Azalea contacts Surf Gear and offers to buy 5,000 towels from them at $11 per towel. Based on the following facts, should Surf Gear managers accept Azalea's offer? Here's what we gain when we're looking at different information. No subsequent sales to Azalea are anticipated. Now, our fixed manufacturing costs are based on 45,000 towel supply production capacity. That is, all fixed manufacturing costs related to the production capacity are available, are related to capacity available, not the actual capacity used. So what's going to happen if Surf Gear accepts a special order? We're going to use some of our existing idle capacity, or the capacity not used, to produce the 5,000 towels, so therefore fixed manufacturing costs will not change. The next bit of data we're given is that the managers found out no marketing costs will be necessary for the 5,000 one-time only special order. And we also find out that accepting the special order is not expected to affect the selling price or the quantity of towels sold to regular customers. So based on knowing that I'm going to use existing capacity, because I already have unused capacity, fixed manufacturing costs will not change. No marketing costs will be incurred. So let's take a look now and see which costs are relevant in the decision-making process if we were between taking the order and not taking the order. So what's our cost of goods sold? Our variable manufacturing costs are relevant. Why? Because we're told that because variable manufacturing costs, we're not going to incur those costs on a per unit or on a per unit basis unless we make the towels. But the per unit cost, we remember from variable, the definition of variable, the per unit stays the same. The total amount we spend is what's going to change with levels of activity or levels of output. So I'm still going to incur my $750 of variable manufacturing costs. We're told that fixed manufacturing costs are not going to change. So we're not going to, and we remember with fixed manufacturing costs, the total is not going to change. So the cost on a per unit basis is going to be irrelevant in making a one-time special order for Azalea. So this $450 is irrelevant on a per unit basis. We're told we're not going to incur any marketing costs, so all of these right here are going to be irrelevant. So the only relevant information here in this situation is going to be the $7.50 it takes for variable manufacturing costs. Now, let's take a look here. Now, Azalea offered to buy 5,000 towels from them at $11 per towel. So now, based on choosing what information was relevant and based on this information here we gathered, let's take a look at the order and our comparison with and without the special order. If we just take the special, the normal 30,000 units we're going to sell, with our regular clients and our regular customers, all costs are relevant because they are the ones supporting the company's operations. So we have operating income of $30,000. Now, what if, in the decision-making process, what if I do accept the special order? Well, then I'm going to get additional revenues of $11 per towel times 5,000 towels. And that gives me an extra $55,000 of operating income. And so my total revenues, total revenues, my differential revenue between the two decisions I have to make, $55,000. So my incremental revenues are $55,000. The difference between the $600,000 and the $655,000. So that's the incremental jump in revenue here. Remember that our variable manufacturing costs are going to be relevant. So we're going to incur $37,500 of additional variable manufacturing costs. Also remember that our fixed costs, all of our fixed costs are not going to change. So those become irrelevant in the decision-making process. So at the end of the day, I'm taking my revenue, $11, and let me just do this over here on a per unit basis on my calculator here. Sales price of $11 minus the relevant costs in this situation of $7.50 gives me additional contribution margin of $3.50 per towel, and times 5,000 towels, I'm going to have additional contribution margin of $17,500 as we see over here in column H. And since there's no additional fixed costs, that additional contribution margin goes straight to the bottom line when we're talking about operating income. So my operating income without the special order is $30,000. My operating income with a special order, if I do decide to take that extra 5,000 units for Azalea, my total operating income will be $47,500, which is a $17,500 increase. So based just on the numbers alone, I would want to take the special order and produce that 5,000 towels. Now again, we have to consider other factors. In this case, the management did anticipate other factors. No other sales are anticipated. Fixed manufacturing costs are not going to change. No marketing costs. It's not going to, and affecting the special order will not affect the selling price or quantity of towels sold to regular customers. So based on all the information and the dollar amount that we had here of increase in our operating income, we should definitely do it. So now let's go ahead here. And two things we should absolutely worry about in the decision-making process. Incorrect general assumptions. Well, actually, that's one thing. Well, there's two things here. Incorrect general assumptions. There are two general assumptions. One, that all variable costs are relevant and all fixed costs are irrelevant. Now, in our situation we just looked at for surf gear, all variable costs were not relevant. Why? Because we did not incur any marketing costs that were variable. In our situation, we did not incur any additional fixed costs, so it was irrelevant in our decision-making process. So even though our example, we had no additional fixed cost, there may be times where we have to produce a special plate, a special die, or something else, special logo that we have to incur in order to make that special order. In that case, we would have an additional fixed cost. So incorrect general assumption. All variable costs are relevant, all fixed costs are irrelevant. While they do hold generally true, we have to analyze it on a situation by situation basis. And again, like we talked about in chapters before, be aware that unit fixed cost data can potentially mislead managers in two ways. One, fixed unit costs might include irrelevant costs. Costs will not change whether or not we accept a one-time only special order. And then if we use the same unit fixed costs at different output levels, we may eat erroneous conclusions. So in most decisions, we should look at the total amount of fixed costs used. Now let's take a look at short-run pricing decisions. When we talk about special short-run pricing decisions, we're talking about special, kind of like a special order, where Sometimes the decision is simply about setting an acceptable price, not necessarily accepting a special order. So remember the decision rule, any price above incremental cost will improve operating income. However, we've got to consider capacity, constraints, current market conditions, customer demand, competition, etc., things like that. An example of this was during the pandemic. We saw a lot of things being sold out, toilet paper, Clorox wipes, things like that. So capacity was constrained. Paper towels, the same thing. The current market conditions was that everybody wanted it, customer demand. Current market conditions was the health situation. We didn't know what was going on, so we wanted to wipe everything down, keep everything clean. We don't want to run out of toilet paper. The stores were closed for a long period of time, so forth and so forth. So capacity constraints, a lot of companies couldn't keep up with it. So eventually, one of their tactics was to raise the prices a little bit to cover the additional costs of PPE, or the personal protective equipment they had to implement in their manufacturing settings. As well as another thing that they had with capacity constraints is that they had too many different offerings. For example, AngelSoft, you could buy those in all different types and sizes and so forth. Well, with capacity constraints, and customer demand, companies like AngelSoft, the makers of AngelSoft, reduce the amount of offerings so that they wouldn't have the setup time to make different batches, so that way they can run and have more output based on that customer demand and so forth. But in our situation, we're going to simply look at about setting an acceptable price. Insourcing versus outsourcing, make or buy decisions. Now, outsourcing is just simply purchasing goods and services from outside vendors. Insourcing means you'll produce the goods or provide the service in-house, or the company that you work for is going to do the job themselves. Outsourcing means we're just going to do it. Someone else is going to do it for us. Now, decisions about whether to insource or outsource, these are called make or buy decisions. One of the things we're going to take into account in the make or buy decisions is opportunity costs. In opportunity costs, if we remember, is what are we giving up to choose this course of action? That's the basic essence of that. And so opportunity costs in our situation is going to be the contribution to operating income that's given up or foregone by not using a limited resource in its next best alternative use. So let's take a look at a few things here, and then we'll go back to the textbook. To make good decisions here, managers must consider the difference in relevant costs, including the cost of idle capacity and the related fixed costs. Are those costs going to be incurred if we decide to outsource? If we decide to outsource and those costs will not be incurred, we can shed some of those fixed costs. Then that reduces the cost of our idle capacity, or the amount of capacity we are paying for that we are not using. Now, outsourcing decisions will have long-run decision. Will have a long-run horizon in which financial costs and benefits of outsourcing become more and more uncertain. So the longer we go out in time, the more uncertainty there is. So in this situation, strategic qualitative factors become important determinants of outsourcing. Some of those decisions we'll have to take a look at and include that are non-financial or qualitative. Will be, what about the extra time to inspect goods, because we don't know? What about delivery times? Is it going to take us a lot longer to get the products if we need to place an order, or are they going to come pretty quickly? Different things like that. Do we have a risk of technology theft? That could be a very big consideration for certain technology-based companies. So weighing all these factors is going to require really a lot of managerial judgment and care. Now, international outsourcing requires managers to evaluate manufacturing and transportation costs, exchange rates, such as the supply chain, the quality, reliability, efficiency of the supply chain, and then again, the theft of intellectual property. And that's probably one of the biggest outsourcing things we have to look for in making outsourcing international. Now we're going to have two approaches to making the make or buy decision. The one is the total alternatives approach, and this means that simply we should take into account future costs and revenues for all products. For example, if we have idle capacity, but then we can reuse the idle capacity to make another product that can produce additional operating income, then we should take that into consideration. There's the opportunity cost approach, where the opportunity cost approach is simply we're going to have someone else do it for us, and then we're going to leave our capacity or our facilities idle, our extra capacity idle. So what are we giving up? What is the opportunity cost that we're giving up? So because if we use resource one way, means we have to forego using the resources in a different way. So if I choose to leave my capacity idle, my additional and my excess capacity, if I outsource, my manufacturing facility is going to be idle, or there's going to be a reduction in the amount of capacity needed. So with that reduction of capacity needed, what am I going to do with that extra capacity? If I choose to do nothing with it, then I have an opportunity cost because I'm foregoing additional potential operating income. And then another thing we're going to take into account is the carrying costs of inventory. And this is going to be really another situation here that we really have to take a look at. And we're going to actually examine here in just a second once I get to the textbook here. And let's take a look at the approach versus the make or buy situation. The make or buy situation, and let's suppose that the company is Digitech. So the company, or the Soho company rather, Soho company makes a DVD player at the Soho company. So they're looking at outsourcing the making of that DVD player. So it currently costs them $15 million to make. They got an offer from another company to buy those for $16 million. So on the face value of it, we see this in aggregate under total relevant costs and then relevant cost per unit over here on the right in this panel. And based on this information alone, should we make the decision to buy from an outside vendor for those DVD players, or should we make those in-house? As of right now, just based on this information alone, we should make it in-house. Why? Because we're going to save $1 million. It's only going to cost us $15 million if we make them ourselves, and then $16 million if we buy them from someone else. Now, let's take a look at the decision-making process here for outsourcing, for the total alternatives approach versus the opportunity cost approach. And this is where we see the opportunity costs implemented and taking a look at everything. Here's how are we going to deal with the idle capacity that we no longer have, or that idle capacity that we're going to have if we outsource the making of the video systems. Well, remember that up here in panel A, if we choose to make those DVD systems, those video systems, the DVD players, and not make this Digitech portable DVD players, it's going to cost us $15 million and $16 million to outsource it. But now, if I have idle capacity I can now make those digitex, because that's what I'm going to do if I choose not to make my video systems. If I make my video systems, I don't have enough capacity. I can't make those digitex. So if I outsource it, I can now make the digitex. If I keep my video systems in-house, then I cannot make the digitex. So what we're going to look at here is, if I choose to make the video systems in-house, it's going to cost me $15 million. But what if I outsource and I pay a little bit more for outsourcing, $1 million more? Remember, we just looked at that in the other panel. But if I can now take that idle capacity and make these Digitech portable DVD players, I can generate extra operating income of $2,500,000 that I would not have had otherwise. So in this case, the net cost of my decision to outsource is only $13,500,000. Why? The initial cost of outsourcing minus the additional revenue or additional operating income I'm gaining. So the net cost of that decision then is $13,500,000. So now, do we favor outsourcing? We should, because now that we can outsource, yeah, we're spending $1 million more, but in exchange for that $1 million more, we're freeing up capacity and we're gaining $2.5 million of additional operating income. So the net difference there is $1,500,000 between the alternatives. Now I want to favor buying the video system DVD players so I can make the Digitech, so I can get that additional operating income that I would not have had otherwise. Now let's take the panel B approach, the opportunity cost approach to the make or buy decision. And the opportunity cost approach says, well, I'm still going to look at the cost of insourcing versus outsourcing, but what if I choose not to do anything? What if I choose to just leave that capacity idle? Then what I'm doing is my opportunity cost is I have no opportunity cost with buying the DVD systems because I'm not giving up anything over on the buying the video system side. But what I am giving up in opportunity cost is $2.5 million of additional operating income. So if I choose not to do anything, then I'm foregoing contribution margin of $2,500,000. So really the total cost of making those products in-house is $17,500,000. Because remember, if I make those video system DVD players, I cannot make the Digitech because I don't have the capacity to do that. I can only make one or the other. So if I make one or the other, then by choosing to make those in-house, I'm foregoing, or that's my opportunity cost of $2.5 million. So really the total cost under the opportunity cost approach, $17,500,000, where the cost of buying the video system DVD players is $16 million. So again, both panels, the outcome is the same. Cost of alternative 2 is $1,500,000 less than alternative 1. In the system, in the panel B, the differential in cost is $1,500,000 as well. So we see this from two different perspectives here, because in this perspective here, if I make it in the total alternatives approach, I'm going to outsource it, but I'm not going to generate additional income. The opportunity cost approach focuses on what am I giving up if I make the product in-house. And in this case, if I make the product in-house, if I make those video systems in-house, I'm giving up the additional operating income from Digitex because I can't make them because I only have the capacity to make one or the other. So that is the difference between those two alternatives there. So now let's go back and talk about carrying costs of inventory. Now remember, the opportunity cost approach, the relevant cost of any alternative is the incremental cost of the alternative plus the opportunity cost of the foregone profit from choosing the alternative. Carrying cost of inventory comes up. We have an opportunity cost here because we're tying up money in inventory and not investing it elsewhere. Let's take a look at how that works. How that works is that, let's take a look here. If we decide to purchase these units for Soho's DVD player purchasing decision, let's say we estimate requirements next year 250,000 units. Depending on when we order and how much we ordered at a time, we're going to be given a price break or not. In this cost, if we purchase 2,500 units at a time very frequently, twice a week, then our cost per unit is $64. But what if we order in bigger quantities? Well, if I order in 30,000 units at one time, I'm going to get a 0.5% off of a discount, $63.68. Now that sounds very good. It sounds like, oh, we're making an extra, 32 cents off each unit. So if I take my 32 cents per unit times 250,000 units, I'm going to gain an additional $80,000 of operating income. Wow, that's a lot of money. But we cannot stop there. Why? Because, let me get out of this there. Because we have some other things to consider. The cost of a purchase order, which is $100 or $150 per order. So if we make 100 purchases, which would be twice a week of 250 or 2,500 units each year, or the other alternative is to make 8 purchases twice a quarter of 31,250 units during the year. So either A or B. A, I make 100 purchases twice a week of 2,500 units, or B, I just make 8 purchases instead of 100, and I'm going to do that twice a quarter, and I'm going to order 31,250 units during the year, or per order during the year. And then now we have to take into account our average investment in inventory. Our average investment in inventory is going to be the number of units times that we have under each alternative times the cost per unit. And then we're going to take that and divide it by 2. So under alternative A, where I buy smaller but more frequent inventory, the number of units I'm going to purchase each time I make a purchase, 2,500 units, times $64 per unit. I'm going to multiply that out and divide it by 2, and my average inventory is $80,000. Under alternative B, my average inventory is simply going to be the amount of units I order at each time times the cost per unit. Take that total and divide it by 2. And my average inventory under the second alternative is $995,000. So what I have to do here is figure what is the difference between these two alternatives in my average investment in inventory. So the difference between my average investment in inventory, 995,000 minus 80,000, and that's going to give me the difference of $915,000 between the two. So I'm going to incur $80,000 no matter what, but if I choose alternative B, I'm going to incur another type of inventory of $915,000 on an average basis. So now let's take a look at taking into account that what we could do with that freed up money if we were to invest it elsewhere. So what if I choose to only purchase 2,500 units at a time versus any 31,250 units during the year? So first of all, my annual purchase order costs are going to go down by 13,800 if I choose alternative B over alternative A. If I take my annual purchase costs, I'm going to save $80,000. We had just calculated that on the calculator here. So at this point, before I consider the carrying cost of inventory, how much am I going to save if I make alternative B my choice, where I just make 8 purchases of 31,250 units each during the year and invest any excess cash? It's going to be what? 13,800 plus 80,000, 93,800. So far, without considering the cost of carrying costs of inventory, we're looking at saving $93,800 just by choosing alternative B and making those big purchases throughout the year. However, inventory does have a carrying cost, whether it's extra warehouse space, extra utility space, overhead, so forth, insurance and so forth. There is carrying costs involved. So the carrying cost involved in this situation is already built into is already there. But what if we could take that investing that cash not tied up in inventory elsewhere at the same level of risk? Remember, we did have a difference in the carrying amount of inventory of, what was that? 995,000 minus 80,000. So I have an extra $915,000 tied up in inventory if I choose alternative B. What if I choose alternative A, spend a lot less per purchase order, and then take that $915,000 on an annual basis and invest that at 12%? Well, if I invest that at 12%, then I'm actually gaining an additional $109,800 worth of additional cash, additional revenue, additional cash flow coming in. So now when I take that into account here, because under alternative A, I could take that $915,000 and invest it at 12%, I'm going to offset all of these costs by $109,800 worth of additional revenue. Under alternative B, that $915,000 is tied up in inventory. So therefore, I cannot invest that $915,000. So I'm not going to get any investment tied up with cash not tied up in inventory. So the difference between the two alternatives is $109,800. So then when I take the carrying costs into consideration, the carrying costs not only include all the other stuff, but it also includes cash tied up in inventory that could be invested elsewhere. So cash invested elsewhere under alternative A, I'm going to get an extra $109,800. Whereas in alternative B, I've got all the inventory. My inventory is just sitting there on the shelf waiting to be sold. It cannot generate any additional revenue because it's sitting on the shelves. Whereas if we don't buy as many, we can actually take that difference in cash that we would have otherwise under alternative B. We can take that additional cash, invest it at 12%, gain $109,800. So now when I take that into account, my relevant cost under alternative A is $15,905,200. Under alternative B is $15,921,200. So the difference, $16,000. I'm actually coming out ahead by placing more orders for smaller amounts and getting that twice a week for the entire year, even if I'm paying more per unit. Why? Even though I'm paying more in annual purchase order costs, and then for placing the purchase orders, and even though my cost of inventory itself is more, I'm offsetting that if I make those smaller purchases because I'm able to invest that difference in average dollar amount of ending inventory. My average inventory, I'm actually able to take that, invest at 12%, and actually earn more than what I'd be saving if I chose alternative B. So, and then And then so with this, and this is just another panel here of how we're saving $16,000 by actually making smaller, more frequent purchases. So that is the carrying cost of inventory. It's not only the incremental cost of the alternative plus the opportunity cost of profit foregone from choosing that alternative. So the opportunity cost of holding an inventory is the income foregone by tying up money in inventory and not investing it elsewhere. Now let's take a look at capacity constraints. So let me get over here. If we have capacity constraints, our product mix decisions are going to be what products do we sell and in what quantities. Like we talked about a little before with AngelSoft. You know, they may have 5 or 6, 7, 8 different products, same product, just packaged up 5, 6, 7, 8 different ways. So the decision rule is going to be, with any type of constraint, choose the product that produces the highest contribution margin per unit of the constraining resource. So we do not focus on the highest contribution margin per unit of the product, but the highest contribution margin per unit of the constraining resource. So if we're limited by machine hours, if we're limited by direct labor hours, we want to focus on the highest contribution margin per unit of whatever that constraint is. So let's take a look here and see that over here. And let's take a look here back at the ebook here. Now, let's take a look at Power Recreation. They assemble 2 engines, one for snowmobiles and one for boats. Here's the basic information about the snowmobile engine and the boat engine. The snowmobile engine has dollar-wise contribution margin per unit of $240. The boat engine has contribution margin of $375 per unit. So based on the contribution margin per unit, if we're going to say $375, boat engine, we should focus on boat engines. But what is the actual contribution margin per unit of constraining resources? And let's take a look here, because that may or may not change our decision. Now, we have some basic information here that we're given. Contribution margin per unit, $240 for a snowmobile engine, $375 for the boat engine. But the machine hours required to produce one unit, this is key here because they do not consume resources or machine hours equally. The snowmobile engine only takes 2 machine hours, whereas a boat engine takes 5 machine hours to produce. The contribution margin per unit of the machine hour for the snowmobile engine, when I take that $240 and divide it by 2 machine hours, I'm going to get $120 per machine hour by producing snowmobile engines. If I produce a boat engine, yeah, I have contribution margin of $375 per unit, but if it takes me 5 machine hours to make each boat engine, then I'm only generating contribution margin of $75 per machine hour. So if I focus on making all my snowmobile engines and no boat engines, I'm going to have contribution margins if my constraining resources, let's just say my constraining resource is 600 machine hours. I have 600 machine hours. I can sell as many as I want of each engine, snowmobile or boat engine. Which one should I focus on? Well, if I focus on making only snowmobile engines, based on my constraining resource of machine hours, I'm going to generate contribution margin of $72,000. But let's say I choose not to make snowmobile engines and I'm only going to make boat engines. I only have 600 machine hours, so if I make all boat engines, I'm going to only have contribution margin of $45,000. So in this case, we see that the contribution margin per unit is not key, but it's a contribution margin per unit of the constraining resource. So I'm going to take my contribution margin per unit, and here's how I'm going to figure this out between the 2 alternatives. Take my contribution margin per unit and divide that by the machine hours required to produce one unit, or by the amount of the constraining resources I am going to consume in the making of that product, whatever it is. In this case, machine hours, it takes 2 machine hours to make a snowmobile engine, a boat engine, 5 machine hours. So I'm going to take my contribution margin per unit and divide it by the amount of that constraining resource that I'm using to give me my contribution margin per unit of that constraining resource. And from there, I can take my contribution margin per unit of that constraining resource, multiply that by the number of machine hours I have, and that will give me my total contribution margin for that limited resource. So that's where we want to focus on. In fact, we do an illustration here at the end of the chapter. One of the examples that we work out, one of the exercises, we actually deal with constraint and dealing with that constraint. So, but this is the focus of the contribution margin. When we have a constraint, we don't want to focus in on the contribution margin per unit. We want to focus in on the contribution margin per unit of the constraint. And in this case, the machine hours constraint, it could be labor hours, it could be a number of other things, but in this case, the machine hour. And we see our greatest contribution margin is with making snowmobile engines. Even though they have a lower contribution margin per unit, they have the highest contribution margin per unit of the constraint. So, and that will wrap up this segment here. That will wrap up this session here. So this is Leroy Meadows. I want to thank you for joining me. Have a good day.